Most people think they lose money in crypto because they picked the wrong coin. They don't. At least not most of the time. In 2021, a college student watched Dogecoin explode. Everywhere he looked, people were making money. His friends were posting screenshots. TikTok was full of overnight success stories. Twitter felt like a giant celebration. Every day he told himself the same thing. It's probably too risky. Then one day he gave in. He bought. Not because he understood Dogecoin. Not because he believed in the technology. Because he couldn't stand watching everyone else win. A few weeks later, the market reversed. Most of his gains disappeared. The interesting part: his mistake didn't happen when he clicked the buy button. His mistake happened weeks earlier. The moment he started comparing his life to everyone else's. And that's one of the hardest truths in crypto. Most people don't lose money because of bad coins. They lose money because they lose control of their emotions. My name is Tito, and I spend way too much time thinking about investing psychology, financial systems, and why some people quietly build wealth while others keep repeating expensive money mistakes. Look, most people think crypto is a money game. But here's what most people don't realize. Crypto is really a psychology game disguised as a money game. And once you understand that, a lot of investor behavior suddenly starts making sense. Because the first trap isn't technical. It's emotional. FOMO. And honestly, social media turned it into a financial weapon. Imagine two investors discovering the exact same coin. The first investor finds it 6 months before anyone cares. The second investor finds it after thousands of people start posting profits. Same coin. Different psychology. The first investor feels uncertainty. The second investor feels urgency. And urgency is dangerous. Because urgency makes people stop asking questions. Instead of asking, "Is this a good investment?" they start asking, "How fast can I get in?" Now here's the strange part. Most investors think they buy because they're excited. Often they buy because they're afraid. Afraid of missing out. Afraid of being left behind. Afraid of watching somebody else get rich. The crowd feels safest right before danger. And the crowd mistakes agreement for truth. But that's not the only emotion crypto weaponizes. Because eventually greed turns into fear. And fear is where things get really expensive. In May of 2022, crypto investors woke up to something terrifying. Luna was collapsing. Billions of dollars were disappearing. People who thought they had found financial freedom were suddenly watching years of savings evaporate. One investor had spent years building a 6-figure portfolio. Within days, most of it was gone. He couldn't sleep. He checked prices every few minutes. He kept telling himself things would recover. And that's when fear took over. Now here's what most beginners misunderstand. The market didn't change overnight. His emotions did. Behavioral economists call this loss aversion. Humans feel losses much more intensely than gains. Which means losing $1,000 hurts far more than making $1,000 feels good. And that's why panic selling happens. People don't sell because they've calmly analyzed the situation. They sell because uncertainty becomes emotionally unbearable. Many beginners buy during excitement. Then sell during fear. Which means they repeatedly buy high and sell low. The exact opposite of what they intended to do. And here's the painful irony. Many portfolios recover long before their owners do. But even fear isn't what destroys most people. The next trap is much quieter. Overtrading. This one feels productive. Which is exactly why it's so dangerous. Crypto never sleeps. The market is open 24 hours a day. 7 days a week. A beginner opens an app to check prices once. Then twice. Then 10 times. Before long, checking charts becomes a habit. Then a routine. Then an obsession. One trader spent months making dozens of trades every single day. He felt busy. He felt active. He felt like a professional. At the end of the year, he had underperformed people who simply bought quality assets and did nothing. The scary part. He worked harder. He paid more attention. He spent more time. And still got a worse result. Because activity feels productive. But activity and progress are not the same thing. Many investors don't lose money because they do too little. They lose money because they do too much. The market rewards patience. Social media rewards excitement. Those are not the same thing. But here's where things become truly dangerous. Leverage. This is where small mistakes become catastrophic mistakes. A trader turns $5,000 into $50,000 in a few weeks. Social media loves the story. Thousands of people want to know his secret. Nobody pays attention to what happens next. A month later, he loses everything. Gone. Because leverage doesn't just amplify gains. It amplifies emotions. Greed becomes greedier. Fear becomes stronger. Confidence becomes arrogance. And arrogance is expensive. The market has a favorite way of punishing investors. It rewards them too early. A big win convinces people they're smarter than they are. Then they increase risk. Then reality arrives. Most people think leverage is a money tool. It's really an emotional amplifier. And emotional investors rarely survive long enough to learn. Which brings us to the real problem behind everything we've talked about. Emotional investing. Most people believe they're making rational decisions. They're not. They buy because influencers sound convincing. They buy because prices are rising. They buy because everybody online feels optimistic. Then they sell because headlines become scary. They sell because Twitter becomes negative. They sell because uncertainty feels uncomfortable. The decision changes. The psychology stays the same. And here's what most people never realize. Most investing mistakes are emotional before they're mathematical. People think success comes from finding the perfect coin. Often it comes from avoiding emotional decisions. Crypto doesn't test your ability to predict the future. It tests your ability to stay calm when nobody else is. And that's why risk management matters so much. Honestly, risk management sounds boring. Which is probably why beginners ignore it. Beginners ask, how much can I make? Experienced investors ask, how much can I lose? One question focuses on dreams. The other focuses on survival. And survival is underrated. Because in crypto, you don't need to win every opportunity. You don't need to catch every pump. You don't need to maximize every trade. You mainly need to avoid catastrophic mistakes. That's it. The goal isn't perfection. The goal is survival. Because surviving long enough gives you another chance. And another chance. And another chance. Social media makes this incredibly difficult. Because online, everybody looks like a genius during bull markets. People post perfect trades. Huge profits. Luxury lifestyles. Life-changing wins. Almost nobody posts panic attacks. Liquidations. Failed strategies. Emotional breakdowns. Or devastating losses. The internet shows outcomes. It hides consequences. And that's why so many beginners develop unrealistic expectations. They think everybody is making money. When in reality, many people are simply hiding their mistakes. Confidence online is often performance, not reality. And here's something interesting. The people who survive crypto long-term usually don't look like the people social media celebrates. They're calmer, more patient, more disciplined, less emotional. They understand that markets move in cycles. They understand uncertainty never disappears. They understand that no opportunity is worth risking everything. And most importantly, they understand themselves. Because the biggest lesson crypto teaches has nothing to do with blockchain. Nothing to do with wallets. Nothing to do with technology. Crypto exposes human psychology. Greed. Fear. Impatience. Ego. Overconfidence. It magnifies all of it. Which is why two people can buy the exact same asset and get completely different outcomes. One panics. One stays patient. One reacts. One follows a plan. One lets emotions lead. The other lets discipline lead. Remember that student from the beginning. The one who bought Dogecoin because everyone else seemed to be getting rich. His biggest mistake wasn't buying the wrong coin. It wasn't bad timing. It wasn't even lack of research. His biggest mistake was believing the battle was happening on the chart. Because the real battle was happening inside his head. And honestly, that's the lesson most people learn too late. Crypto doesn't create greed. It reveals it. Crypto doesn't create fear. It exposes it. Crypto doesn't create emotional weakness. It magnifies it. Most people enter crypto looking for financial freedom. But crypto usually teaches a different lesson first. Patience. Discipline. Humility. Because the biggest enemy in crypto was never Bitcoin. It was never Ethereum. It was never the market. It was the person staring back at you every time you opened your portfolio.